October 29th was Super Thursday. It was the day that 4 of the 5 FAANG stocks reported calendar third quarter earnings. So we had Facebook, Apple, Amazon, and Alphabet. Now Apple delivered an all-around beat, which is basically revenues and earnings that exceeded expectations. However, the stock was down about 4% in after-hours trading. But before we talk about why that might have been the case, let's discuss a little bit the results of the quarter. So it was very clearly, Apple's results were very clearly divided or separated into two. So on the one hand, you had very strong results coming from virtually every product category. So the iPad saw revenues grow by more than 40%, which was the best performing segment for Apple, followed by the Mac and then by services. And those were all fueled by what we call the stay-at-home economy that basically carried momentum forward from the second calendar quarter into the third. Now, on the other hand, you had the iPhone. And the iPhone, not only did it produce very low revenues that actually dipped by more than 20% year over year, those results were actually below analyst expectations. It was the only segment of Apple that underperformed relative to what the street was expecting. Now, the stock was down about 4%, and there are a couple of potential reasons why that was the case. The first one is probably the iPhone itself. Of course, the iPhone represents about 50%, a little bit more than that, of Apple's total revenues. And analysts and investors, they still pay a lot of attention to the iPhone, even though Apple has been trying to shift their business model away from the smartphone towards higher growth segments like wearables as well as services. But the iPhone, once again, it's a big item. It was down sharply. I don't remember iPhone revenues being down more than 20%, at least not in the recent past. However, during the conference call, Tim Cook and the CFO, Luca Maestri, they seemed very optimistic about the iPhone and basically blamed all that softness, all that weakness in revenues. They blamed it on the iPhone 12 that was actually launched a little bit later this year than it was in 2019. So pretty much what they're arguing is that it was a timing issue, and basically that when you look at iPhone sales, you should look at it across the 2 quarters, so calendar third and calendar fourth, as opposed to looking at it only as a snapshot for the July through September period. Again, that doesn't seem to have been enough to please investors, and that might be one of the reasons why the stock was down. There are a couple of other reasons, though. One of them is the fact that Apple chose not to provide guidance for the holiday quarter, which, as I indicated in my earnings preview, I thought that would have been the case, especially now that we're seeing COVID cases kind of rise again in Europe and North America. So I saw no reason why Apple would stick their necks out and provide guidance for the holiday quarter. So maybe, once again, maybe that failed to provide the kind of visibility that investors were looking for, and that put some pressure on the stock. However, the third reason is possibly one of the most important ones and most underrated, which is just a simple fact that Apple has had a very strong 2020 so far, and I'm talking about specifically about the stock. So just let's think about the companies that reported earnings this Thursday after the bell. So the 4 FAANG names that I mentioned, plus Twitter. Now let's look at those stocks, and if you look at the performance of those shares from mid-March, which was the bottom of the COVID-19 bear market, through today, basically the top 2 performers were Twitter and Apple, and the bottom performer was Alphabet. And if you look at the market reaction to earnings today, it was exactly the opposite. So you saw Twitter selling off by about 16%, even though the company also beat on revenues and earnings. And the same thing happened to Apple, that was down 4, sometimes 5% after hours, but the stock has been the second best performer among those 5 since March. And then on the flip side, you have Alphabet, which is by far the worst performer of all those 5 stocks since March, and they were up about 7% today after hours. So maybe there's a little bit of that caution on the side of investors that are possibly not willing to pay higher multiples, a higher valuation multiple on those 5 stocks after they have rallied as far as they have over the past 6 to 7 months or so.